So hi everyone, welcome back. In this new lecture we are going to start with the new concept. Before moving ahead to our security valuation chapter and discussing the next concept, let's first revise what we have done till now. In from the formula book I can help you to revise everything. The first thing is that we have discussed about the time value of money, which is simple interest, in which we discussed about lots of concepts. Simple interest, if we can imagine the formula: compound amount, effective rate of interest, present value, future value, present value of annuity, and then perpetuity. In the basics ratios, I will just mark it what ratios we have discussed till now. We discussed about the debt equity ratio. Yes, we discussed about the return on equity. We discussed about the effective tax rate. No, not yet. It was effective interest rate. We discussed about the dividend rate, dividend yield, then dividend payout ratio and price earning ratio. So these points have been covered till now. What's left is this 100 basis point and debt to capital ratio, fixed interest coverage ratio, return on capital employed, cost of goods sold, effective tax rate, weighted average cost of capital, and these are very easy concepts. We'll cover it later on. Then we started with the risk management. The first thing was to calculate the z value to standardize a normal variable. From this formula we calculated value at risk. Value at risk means VAR. Then we calculated the standard deviation, portfolio variance. What do you mean by the portfolio variance? We do not use weight here. Then portfolio VAR. Okay. Then in security analysis, we started with ABI, confidence index, RSI, relative strength index, arithmetic or simple moving average, exponential moving average, run test analysis. And the last one was explain buy and sell signal provided by the moving average analysis. So this is covered in the formula book also. That's why it is given here. Then we started with the security valuation, and if you try to remember Walter's formula, there was something called as dividend based formula, or we can say Gordon's formula: D0 divided by cost of equity minus growth. This is dividend based formula. Or we have also seen in that discounted dividend method, earning based formula, where we do this E0 in 1 plus growth of, this is 1 plus growth divided by cost of equity minus growth, or we can say E0 or EPS into E1 into 1 minus B divided by cost of equity minus BR, something like that, which ultimately gives you the dividend in the numerator. Then comes the enterprise value. Okay, we'll discuss this particular concept in this lecture. We have also seen about the free cash flow to firm, free cash flow to equity, 1 stage, 2 stage and 3 stage model of the valuation of the firm. Okay, so we completed this one, this and this one. Okay, we'll be discussing enterprise value. Just 3 questions are there and the concept is very small, so we'll finish it very quickly. Then right shares will be the main topic. Okay, so this was all that we discussed. Now coming over to a point, I will give you some examples. Okay. Enterprise value. Let me give you some examples. Okay, just a second. This is a cup. This is somewhat yellow and green in color, and that's why you will not be able to see it properly, but I have another way for this. Okay, so this is a cup, and what I'm doing is this is a 5 rupee coin and I'm putting it in the cup. Now you can buy this cup, the total cost as it is in order to buy the cup is 100 rupees. So you will have to pay 100 rupees to me and you can take this cup. Okay. My question to you is, what is the real cost of that cup to you? Real cost of that cup to you. So practically speaking, you will be paying, although you will be paying 100 rupees to me and take it with you. But what you can do is you can just immediately take that 5 rupees coin, right, and put it in your pocket. So practically speaking, the cup is costing you only 95 rupees. Can I say that? So if this is the cup and it has 5 rupees in it, and if you are paying 100 rupees for this cup, practically speaking it is costing you only 95 rupees because you are getting 5 rupees back. Same happens with the company when someone goes to buy the company. When anyone wants to buy the company, they will have to purchase the equity share of that company. So let's say this is a balance sheet of the company and this side equity shares are there. So 10 crore equity shares worth and the market price of that equity share is 50 rupees per share. So practically speaking, you are going to buy this company. You will be the owner of the company by paying 500 crore. 50 into 10, right? So 500 crore is the total cost of the company, but this does not show you the real cost which is being borne by you. See, understand, this is the market value of equity, right? But the moment you buy this company, you also buy the cash lying in the bank balance, let's say 5 crore rupees. So you are immediately getting 5 crore rupees in real cash immediately. So should I say the real cost, in order to calculate the real cost of this purchase, I should deduct the cash amount? Yes, sir. Now I can say that 495 is the real cost. Although I will be paying 500 crore and I can get that 5 crore of the cash back. So market value of equity does not give you the clear picture of the cost that you will be bearing for this purchase. Although you are paying 500, you are getting 5 back. So the real cost is 495. Now, along with buying the company, just a second. Along with buying the company, you also buy the debt of the companies, right? And let's say, for example, in this question, the debt of the companies are 10 crore rupees. Now, what will happen? Don't you think by paying 500 crore, you are buying the liability of paying another 10 crore to the debt holders? Yes, sir. So the moment you become the owner of this company, you will have to pay back 10 crore rupees to the debt holders whenever it's due. So it's not just 500 crore that you will have to pay. You will also have to pay 10 crore rupees more to the debt holders, to the lenders or whosoever they are. So don't you think we should add debt in the total cost? Although we are not liable to pay immediately, but it is payable. It is the present value of the future liabilities, 10 crore rupees. So we should add it. It becomes 505. The real cost of buying this company becomes 505 crore, and this is called as enterprise value. So the entire issue starts from the point of market value of equity, which does not show us the real cost of acquisition of that company, real cost of buying that company. Because 500 crore is not the only amount that we will be paying. We are getting 5 crore in cash back. We will be paying 10 crore in debt also. So that is all the outflow to us. The net cost to us is 505 crore. Okay. You might also say that, sir, current liabilities are there. We need to settle those also. We should also pay that. No. By buying the equity share of the company, you are actually subscribing to the current liabilities and fixed assets and current assets and everything. These are the part of the operation. Fixed assets you are using for the operations, current liabilities you are using for the operations, non-cash current assets also you are using for the operations. So these are not going to be adjusted here because this will continue to be operated year and year and year on and on. So the net cost at the time of buying the company is this 505, and which is called as enterprise value. The concept of enterprise value is very simple. It says that market value of equity does not show us the clear picture, and hence we should add all the other liabilities, long-term liabilities that we will have to pay immediately, and deduct all the cash and cash equivalent that we can get immediately after buying the company. And you get the logic with this, right? 100 rupees of the cup with 5 rupees in that does not mean 100 rupees is the cost to us. The net cost is 95 only, right? So even though you will be paying 100 rupees, but you can get back 5 rupees. So at the back of the mind, 95 is the only figure that will bother you. So in this scenario, 505 is the net cost, or the only figure that should bother you. This is the concept of enterprise value. Have a look on the formula. Come down to page number 12 of the formula book. If you can see here, enterprise value has this formula where you will start from the market value of equity. That was 500 crore in our example. Okay? Then market value of preferred equity is a liability that you are buying. The preference shares in the balance sheet is also is also a liability that you are buying. So it is going to add up to your cost. Market value of the debt is also going to add up to your cost. If there is any minority interest, that is your liability. This comes only when there is consolidation issues, or we can say if the question is related to the consolidation of a holding company and subsidiary and all that thing, then that minority part will be there. Otherwise it will be zero most of the time. And then minus cash and cash equivalent. Investment means cash equivalent, which can be easily converted into cash. So if you are buying 500 crore company and you are getting a cash of 50 crore rupees, then immediately you should deduct it, because this is not the cost to you. So cost is being reduced by 50 crore rupees. So 450 will only be the cost. This is called as enterprise value. It represents true picture. It represents true picture of your purchase consideration, or we can say of your purchase of the other company. Simple. Again, summarizing, market value of equity is not enough when we talk about the acquisition cost or the takeover cost or the cost to buy that company. Although on the face 500 crore rupees if you pay, you get that company ownership, but with that ownership you also get the cash and the liabilities. So add up the liabilities, because that will also be payable by you, and deduct the cash, asset kind of thing, which is easily converted into cash, so that you can arrive at the net cost of buying the company. Okay, so this is enterprise value. Then comes two types of multiple. If you remember, one of the famous multiple is P ratio, where the meaning is price divided by EPS, where let's say for example 100 rupees is the price and 20 rupees is the EPS. We call it as just a second. Yeah, we call it as, let's say the P ratio comes to 5. Then we interpret this figure as 5 times the earning per share is the market price. That means if we want to earn 1 rupee, then we will have to pay 5 rupees in the share to buy the share. So if we will buy the share worth 5 rupees, we will be able to earn 1 rupee from that company. 1 rupees of the earning will cost you 5 rupees. That is the meaning. Similar are the enterprise value to EBITDA multiple and enterprise value to sales multiple. There are different types of multiples which can be formed. 2 of them are given here. And what is the meaning of that? Please understand. EBITDA is also earning, but it is an earning before interest, before tax, before depreciation and amortization. So I can say, because it is taken before interest, I will say this is earning, this is operating earning. Okay, this is before tax, so this is before tax earnings. Also this is before any non-cash expenses, that is depreciation and amortization. So I can say these are the operating earnings cash based operating earnings. Not the entire, but cash based. Non-cash expenses have not been deducted yet. So let's say, for example, your enterprise value comes to around 525 crore and EBITDA of the company is 25 crore. At that time, your EBITDA, enterprise value to EBITDA multiple is 21. What does that mean? It means you will have to pay 20, or not just pay, it will cost you 21 rupees to earn 1 rupees of the cash based operating earnings. It will cost you 21 rupees to earn 1 rupees of the EBITDA, 1 rupees of the cash based operating earning. We cannot say that we will have to pay 21 rupees because this is not the market price. Market price will be only the equity value. But ultimately what is going to cost us is this adjustment in the equity value. So that's why we will say the net cost to earn 1 rupee of the EBITDA will be 21 rupees. Okay. Another part is enterprise value to sales multiple. First of all, understand why sales are taken. Because sometimes in startups, earning before interest, tax, depreciation and amortization comes to losses only. It doesn't come to profitable figures, because in the beginning years of the startups, all you can see is the loss. So at that time, calculating enterprise value to EBITDA multiple will give you wrong conclusions. You can say that because there is a loss, we should not invest in the company, and so and so and so. So you can just take an example. You can take the example of the Paytm, Cred, Flipkart, all these companies, Swiggy, Zomato, all these companies right now are in losses. So if you calculate the enterprise value to EBITDA multiple, it will not give you good figure. They will show you that you will be paying 21 rupees for 1 rupees of the loss, not the earning. Who would pay to bear the loss? No one. So at that time, this multiple will not help. But in reality, we know Swiggy is an important company, is a valuable company, and if you can become a part of it, it will be very good. So at that time, we need some other basis to understand the enterprise value or the cost per unit of earnings. So we have taken sales because turnover is the important factor in all these startups. Although the profit is not there, but turnover can speak a lot about these startups. So at that time we calculate enterprise value to sales. So let's say, for example, 525 crore is the enterprise value and the sales is 1200 crore. So not the 1200 crore, let's take another figure. Sales is, let's say, 100 crores. So at that time 5.25 rupees is the cost to you for 1 rupee of the sales. So once you pay 5.25 in the company, you will get 1 rupee of the sales every year. That is what the meaning of this multiple is. In this formula, the 1 rupee was EBITDA, earnings. In this formula, 1 rupee is the sales, which is in the denominator, and 21 and 5.25 is the cost that you will have to bear. It's not the price that you will have to pay, it's the cost that you will have to bear ultimately. This gives you more clear picture of how you are going to spend your money. So this is all about the enterprise value. Let's take some questions and then move ahead. Question number 43 is there. Have a look. The balance sheet of H Corp Limited is as follows. You can clearly see there are non-current assets of 1000. Current assets of trade receivable and cash equivalent is 500 and 500. So non-current assets, please just put an arrow there and write down fixed assets. Fixed assets, long-term investment, etc. In the current assets, you have trade receivable and cash equivalent of 500 and 500 each. On the other side, shareholders fund 800, long-term debt 200, current liabilities and provision 1000. Now, the shares are actively traded in the market and the price is 12 rupees per share. Shareholders fund represents 70 shares of rupees 10 each and rest is retained earning. So understand, 70 shares of rupees 10, that means 700 is the paid up capital and 100 rupees is the retained earning. Rest is the retained earning. So 800 comes like this, 700 plus 100. Okay, so the total number of share in here is only 70. Rest is retained earning. You are required to find out the enterprise value. So enterprise value starts with the market value of equity, 70 into 12 rupees. 70 into 12 rupees is 840. So 840 is practically speaking the amount that you will have to pay to buy entire company. But the story won't end there. That's not the only outflow. After paying 840, you are also taking the liability of 200 rupees. So today or tomorrow you will have to pay 200 rupees also. So consider that one as a cost to you. But the good part is you are getting cash and cash equivalent immediately after buying this company. So 500 rupees can be deducted immediately. If you do the calculation, it will show you the net cost to you, which is 540 only. So 540 lakhs or whatever the amount is the enterprise value or the real cost of buying the company. Although you will be paying 840, but you can clearly see we are getting back 500 rupees in cash and cash equivalent. So what's the matter in that? Practically 540 will be the net cost to you. Okay, let's move ahead to the next question. Question number. Acha. Since no information on the market value of the debt has been given separately, the book value has been assumed as the market value. That's a good point. I forgot to tell you. Long-term debt of 200, which is given in the balance sheet, is the book value of the debt, and that doesn't matter at all. This is not important at all. If you look at the formula, have a look. We'll go back to the formula book and we'll just mark a couple of things. We have not focused on this thing, and it is very important. Market value is important. So book value should not be taken while calculating the enterprise value. Market value should be taken. Since there is no market value given for the debt in this question, we have assumed that the book value and the market value will be same. And that's why the market value comes to 200 lakhs. Cool, enough. Let's move on to question number 45. There is an analyst has determined that the appropriate, please understand, appropriate EV by EBITDA. That means how much is the enterprise value for 1 rupee of EBITDA. For Rainbow companies, 10.2. So practically speaking, in order to earn 1 rupee of EBITDA, you will have to bear a cost of 10.2. 10.2 is the enterprise value for 1 rupee of EBITDA. The analyst has also collected the following forecast information for Rainbow company: EBITDA, market value of debt, cash, and then you have to calculate the value of equity. This is just a reverse calculation. See, if you look at the formula of enterprise value, they have asked you to calculate this figure. And they have given you market value of the debt, which is 56 lakhs or 56 millions. Cash is also been given to you, that is 1.5 million. The only thing that you need in order to calculate market value of equity is the enterprise value. And enterprise value can also be calculated by using EV by EBITDA multiple. See, EV divided by EBITDA is equal to 10.2. You put the figure of EBITDA 22 million there. So EV is equal to 22 into 10.2. 224.4. So 224.4. Now you can easily calculate the market value of equity. Is this question a very difficult one? No. 224.4 minus 56 plus 1.5, you will get the market value of equity. Have a look. 224.4 million is equal to equity value plus 56 millions minus 1.5 million. The equity value comes down to 169.900 thousands. Okay, let's move on to the next question. Question number 45. George Zaldiz is a CFA, Chartered Financial Analyst, is researching the relative valuation of two companies in the aerospace defense industry. NCI Heavy Industry is one company, Relay Group International is another one. He has gathered relevant information of both the companies, Relay Group International and NCI Heavy Industries. Price of the share of each share of the company is 150 and 100. Shares outstanding is 5 million and 2 million. That means 50 lakhs and 20 lakhs. Market value of the debt, book value of the debt. Have a look on this. Both of these are debts, but one is the market value, the other one is book value. Cash and investment, net income, net income from continuing operation. So this is same, but this is not same. That means in 12, whatever it is, lakhs or whatever it is, 12 million, 4 million or something is included, which is the profit, but those operations have been discontinued now. So 12 is the total of 8 plus 4. 8 is the income from the operation which will be continued next year also, but 4 is the income from such operations or such a business which is discontinued now. So for the future reference, 12 is not important. What is important is 8. Interest expense 3 and 5, depreciation and amortization 8 and 4, taxes are 2 and 3. Using the following information, answer the following question. Calculate P by EBITDA for NCI. Please put an arrow for P and write down price, market price per EBITDA for NCI. And calculate EV by EBITDA for NCI and RGI. Which company should Zaldis recommend as relatively undervalued? Justify the selection. See, in the first part, you can clearly see they have put a market price per share. P means the price per share in the numerator. It automatically means the EBITDA that you are going to take here should also be calculated as per share. Because whatever the calculation you are going to do, make sure that the base in the numerator and the denominator are same. So if the numerator is per share, the denominator should also be per share. Thus, in the second part, it is in total value. It is not per share. So price is already given to us. We need only 3 figures. Please understand. Only 3 figures. The price, EBITDA and enterprise value. The price is already given to us, the first figure. The second thing that we need to calculate is the EBITDA. And we have to reach here, EBITDA. Now understand, what happens after EBITDA? You deduct depreciation and amortization and reach at EBIT. Then you deduct interest and reach at EBT. Then you deduct tax and then you arrive at EAT. EAT is nothing but the net income, but this net income is not helpful. This net income will be considered net income from continuing operations. Okay, good enough. So take those figure and do the reverse calculation. If you have deducted some amount like tax, interest and depreciation, add all of them back to arrive at EBITDA. So we will start with this 49.5 and see what happens. 49.5 taxes 2, EBT earning before tax will be 49.5 plus 2, that's 51.5. Then you will add back interest, which is 3. This will be 54.5. Depreciation and amortization 8. 62.5 is your EBITDA. Good enough, right? Then comes to the second part. You take EAT and then add everything back. You will get the answer. Okay. So let's calculate it. Let me tell you one thing. Just do some marking. There are some figures which will help you to calculate EBITDA. This much will help you to calculate EBITDA. This is for EBITDA only. And this will help you to calculate enterprise value. This is the information for enterprise value. So let's first calculate EBITDA. See, for RGI, we started from 49.5. We added 2, 3 and 8. What is 2, 3 and 8? It is tax, interest and depreciation and amortization. So 2 is the tax, 3 is interest and depreciation and amortization. In NCI, we will start from 8 and not from 12 because 12 is not important from the future point of view. We are not going to earn 12 anymore because 4 Out of the 12 figure, 4 is such an amount which is not going to happen in future. Those business have been discontinued, so it is not relevant. So we started with 8, 3, 5, 4, and then we reached at 20. We did the reverse calculation to calculate EBITDA. Okay, the second item is reached, has been calculated. Now comes the enterprise value, the third item that we need. Enterprise value is nothing but market value of equity. So what is the market value of equity? Price per share, the first two in the row. Price per share into share outstanding. After that you will deduct market value of the debt and after that you will add market value of the debt and deduct cash and cash in equivalent. You will get the answer. See, enterprise value is nothing but market value of equity plus market value of the debt. Understand, market value of the debt should be taken, not the book value. And you will deduct cash and cash equivalent. You will get the enterprise value of both the companies. Now you have all the three figures and you can calculate the ratios. See, I will just go to here. Price per EBITDA per share. So this is the price, 150 and 100. And this is per share EBITDA. 62.5 and 20 millions are total EBITDA. We are going to divide them with number of share to arrive at per share EBITDA. So per share market price, per share EBITDA will be giving us this result. What does this mean? This means that in RGI we will have to pay 12 rupees to buy the share. That means we will have to pay 12 rupees for 1 rupee of EBITDA. And we can get the same 1 rupee of EBITDA by paying only 10 rupees here, NCI. So this company is relatively undervalued. We are getting good price. We are getting good value for our investment in NCI. How you decide undervalued? It's very simple, sir. You are paying less for the same amount of income here. Less for the same amount of income here. Achha, I will give you an example for that. Let's say a market price is 100, market price is 80. Earning per share is 20 and earning per share is 20. So we will come to P ratio. P ratio is 5 and P ratio is 4. So the ratio which is lower, P ratio, in which company it is lower, will be called as the undervalued share. And it is right. You can clearly see from the market price 80 is lesser than 100. It is undervalued. Similar will happen here as well. 10. The ratio of price to EBITDA is 10 in NCI. That is undervalued because it is lesser than RGI. We have to pay less amount for the same EBITDA. See, it means it cost us 12 rupees in RGI and 10 rupees in NCI for the same 1 rupee of income. So we would prefer to pay 10 rupees. Na? If we are getting 1 rupee only, why we would choose to pay 12 rupees for the same amount? Then comes the EV by EBITDA. That means the enterprise value per rupee of earnings. So per rupee of earnings. So 795 is the total enterprise value here, 298 is here, and we have taken total here. In this case, all the values are in total. The result comes to this. That means if you buy the shares of RGI, or the RGI company, it will cost you. I'm not saying you will have to pay, because enterprise value doesn't mean the market price. It means the total cost that you have to bear. So you will have to bear 12 rupees 72 paisa as the cost for 1 rupee of income in RGI, whereas you will have to bear more in NCI for the same income. In this case, RGI is undervalued because you have to pay lesser amount there. So whether the multiple P by EBITDA or EV by EBITDA is a low multiple is always preferred over high multiple. So underline this one. In both the multiple, the low multiple will be preferred. So in this case, we can clearly see in the first part, NCI company is preferred because the multiple is low there. In this case, RGI is preferred because the multiple is low there. So according to P by EBITDA, NCI is recommended, but according to EV by EBITDA, RGI is recommended. Now in this case, what should be done? Because one multiple is saying choose NCI, the other one is saying choose RGI. At that time, keep it very simple. Do you think price is more important or EV is more important? Because the difference in these two is only this. EBITDA is there in both the parts. But what is the difference from first to second? Here we are considering only the market price of equity share, and here we are considering market price of equity share, debt, market value of the debt, and cash equivalent. So according to me, EV is more trusted, we can say, or more recommended measure of multiple to choose or to rely on rather than price. So we should go with EV, not price. I told you in the beginning, the concept of EV is it represents true picture of the cost that you will have to bear. So price does not represent true pictures. EV will represent true picture, and if we go with this model, RGI will be chosen. See, when there is a conflict in decision due to different multiple, EV by EBITDA multiple should be preferred, as it gives proper picture of fair value of the company, whereas price by EBITDA ignores debt and cash balance with the company. RGI is undervalued and recommended for the investment purpose. This is how the question goes. It was interesting question, isn't it? Question number 45 it was. With this, we end our calculate or discussion of enterprise value. In the next part, I will just take a break. In the next part, we will start with the concept of right shares. More on enterprise value can come in exam, and in the corporate valuation also we might have some questions. But that's it about the enterprise value. The one liner for the enterprise value is very simple. Market value of equity is not enough. It does not gives you true picture. It ignores debt and cash balance with the company. So the true picture is given by enterprise value. Hence, we should go with that. See you after the break. Okay guys, so welcome back after the break, and now we are going to talk a lots of things about right shares. So what is exactly the right shares? Let's have a look. The entire story starts from the point where there is a need to raise additional capital. The company requires that we should raise additional capital. So first of all, before going into the additional capital, we should know what are the sources of capital, funding. So this is going to be rights share. Okay. Sources of capital. So in a nutshell, we can say that the major source is equity, then comes the preference, debt holders, we call it as debentures, then loan from the banks and all, etc. There are many other things, but I'm just summarizing it in 4 different categories. And let's talk about equity shares. So this is the first source for the capital. Now let's assume that the company has already issued equity, preference, debenture, loan for XXXX amount, and now after a couple of years, or let's say 5 years down the line, company needs additional funds and they are unable to raise, or they don't want to raise it from preference, debentures and loan. So they are closing down all the rest of the 3 sources. Now it comes to equity. When you want to raise additional capital from equity, there are 2 options with you. Okay. The first option is called as additional shares, or we can say new equity offer. Additional equity shares, or in another term, we call it as FPO, further public offer. Initial public offer, after which this will be issued. Other than this, there is one more thing which is called as rights share. Now what do you mean by right shares? In right shares, additional equity shares will be issued to the existing equity shareholder. This FPO can be subscribed or can be purchased by anyone. This is for public in general. But this right is given to existing shareholder. And the right contains purchase or buying the shares at a discounted price. So company offers shares at discount to the existing shareholders. So let's say, for example, the market price of equity shares of the company is right now 50 and the company is offering it at 40 rupees only. This is called as subscription price. This is called as subscription price. We will call it as S. Okay. And we will call it as P0, means the current price of the equity share. Do you understand the difference between the subscription price and the price of the equity share? Subscription price means the price at which the existing shareholders can buy additional shares at a discounted price, which is 40 rupees. So we are giving the first opportunity to the existing shareholder because in past also they have showed their trust in the company, and that's why it's our duty, the company's duty, that if we are offering or we are adding more shares into the company, the first right should be given to the existing shareholders. After which obviously shareholders can pass on that right to anyone if they do not want to subscribe. So I will talk about it in a moment. Let's first start from the beginning. Like, it's better to draw a timeline of what happens and when it happens. So at very first, the company announces that company is going to issue right share. So this is a point where the company is making an announcement. Okay. After that, there will be a particular date. This date, let's say for example, this is the date, and this date will be called as record date. What do you mean by the record date? The record date means till that record date point, whosoever will be the equity shareholder of the company in the register, they will get the right to buy additional shares at a discounted price. Okay. Just a day before record date, there is a date, and it is called as X right date. Okay. What does that mean? It means that the market price of the share at present is 50, right? It is going to go up till that X right date. And after that X right date, the market price of the share, the share will trade at X right market price. So let me be very clear about it. From this point till this point, if you are buying the share of the company, let's say for example, you don't have any share of the company has also announced the right share, and after that you are buying some shares of the company. Because company has announced it, people can take the benefit of it. So that's why whenever you buy the share in this date, you will that price will be called as the come right price. Come right price means the right price, the value of the right is included in that share price, and after that the share will be traded at X right price. That means it will fall. Do you understand that? After the announcement, there will be huge demand, because still there is a date before which if you purchase the share, you are entitled to the right. And that's why, because of the huge demand, the share price can go up, but that extra price will include the right value, the value of the right that you are going to purchase. So anyhow, it is not of any use. So if you have purchased the share before this date, major benefit will be there, because if you are purchasing the share in these date, you will be entitled to the right, but you will be paying extra for that. So whatever it is, the market price of the equity share from this date to this date will be called as the come right price. And after that price, because this is the ex right date, after that date, the share price of the company, the price of the shares of the company will trade at X right price. Means now if you are buying the share, after this point, if you are buying the share, you will get it at a lower price. Okay, so it may fall to somewhere like 48 rupees, 47 rupees, and that will not include any right. So if you are buying the share at this point, you will not be entitled to any right. Let me give you an example. Okay, so share and right. Let's say the scheme that the company has just announced, about the right issue. Just a second. Is like this, 1:5. What does that mean? It means that if you have 5 equity shares of the company, you can get 1 equity share under right issue at a discounted price. So if those who have 5 shares will get a right to buy 1 share at a discounted price. So this is called as 1:5 ratio. If you have 5 equity shares of the company till this point, you will get 1 share at a discounted rate. You will have to pay for it, but a lesser amount. If you have 10 shares, you will get 2 shares at a discounted price. Okay. So if you are buying 5 shares in this date, the come right date, you will be entitled to purchase, just a second. Yeah. So you will be entitled to purchase 1 share at a discounted price, that is 40 rupees. But if you buy 5 share after the ex right date, if you are buying 5 shares, you will be entitled to nothing. That means you don't get the right to buy the share at a discounted price. So the rights are given only till these dates. Getting it? Okay, clear. Now, let's say for example, you have purchased the shares either before this date or or in this date. So all in all, at this point of time, you are the shareholder of the company in the register. Let's say for example, that means you have the right to buy the share at a discounted price. And let's say for example, you have only 5 shares with you. That means you can buy 1 share at a discounted price. Okay, but when to buy the share? When to buy the discounted share? So there will be some opening and closing date. Let's say for example, these two are the dates. Okay, this will be called as the opening date. Here the right, you can exercise your right. You can buy that 1 share at a discounted price when that opening date comes. And this will be the closing date. That means those who wants to buy the share at a discounted price will have to do so in this date. Getting it? So you can pay 40 rupees and you will get 1 share between those dates, not before that, not after that. Okay, there are some situations where you have the right to buy the share, but you may not want to buy the discounted share, or you might not have that extra money of even 40 rupees to buy that share. So at that time, what will happen? You would want to sell that right to someone else. So there are 3 situations. Whenever you get the right, there are 3 situations. Let me just explain all of them before moving ahead. 1, 2, 3. So the very first thing that may happen is you may exercise the right. Exercise the right means you are buying the shares and you will have to pay 40 rupees from your pocket. That is called as exercising the right. So if you have to exercise the right, these are the two dates in which, between which you will have to exercise. The second thing is, if you don't want to exercise the right, or if you don't have the money to buy extra shares, you can just sell that right to someone else. When you sell that right, you will get something like value of right. Because you are selling it to someone else, you are entitled to receive money. You are entitled to receive money. And how much? It will be equal to the value of the right. That is what we are going to find out in most of the questions. Because you are selling it to someone else. Okay. So if you want to sell that right to someone else, these rights are transferable. Please understand one thing. So if you were the shareholder before the record date, you are entitled to one right and you don't want to buy the additional shares at a discounted price, you can sell that right to me. I will just pay you 2-3 rupees, whatever the value of the share is, value of the right is, and I will get the right to buy the share at a discounted price. Okay, but please understand one thing. If you want to sell that right to someone else, there will be a certain date. Let's say, for example, this is the date. This is going to be the date before which sell rights. This is going to be the date before which you will have to sell all your rights to someone else, so that the other person like me can get this much of the time. Please understand, this much of the time to buy the shares at discounted price, because I should also get the time to buy the shares at discounted price, because the closing date is same for everyone. So your selling date, the selling of your rights, the date of selling of your rights has to be fixed somewhere. It will be very uncomfortable or a complex situation if that date is closer to this date. So that's why we have to keep a gap. So that's why the law says that you will have to fix a particular date where the selling of the rights will be stopped. Okay, so before this point you can sell the rights to someone else, and that other person will get a time from this point to this point. Please understand, from this point to this point to buy the share. But let me take you to the third part. If you do not exercise the right, or if you have sold the right to me and I do not exercise my right till this point. So practically speaking, or in short, if anyone who has the right do not exercise the right till this date, it will expire. So after this date, the rights will expire. We will call it as rights expired. After this date, it will have zero value. From this point till this point, the rights will have value, but after that it will have zero value. It is just like the coupons or vouchers that are issued by some shopping malls, which says that since you have purchased goods or clothes worth rupees 5,000, you are getting 500 rupees voucher. And this voucher, please understand, you do the purchasing here in the shopping mall for 5,000 rupees and you get a voucher for 500, and it says that you can exercise this or use this voucher from this date to this date. But after this date, if you take that voucher to the mall or to that shopping shop, they will say it is expired and it is of no use now. So after this date, rights will expire and it will not be of any use. So the mistake or the worst thing that will happen is rights will lapse. If the right gets lapsed, it is a loss to you. Otherwise, it is not. So these are the things which happens when you get a right. Either you exercise the right, either you sell the right to someone else before the particular date, or you let it lapse. You got the right, but you're not purchasing it, so you let it lapse. Because what happens is that suppose you have a portfolio of 50 shares. No, not 50 shares, just 5 shares. Okay, and the market price of that was 50. So the total portfolio value that you had is 250. Okay, and you got one right to buy the share at a discounted price. But what you are doing is you are doing nothing. You are just waiting and waiting and waiting and waiting. And what happens is after this particular date, after this date, the price of the share comes down. So it may come down to, let's say, 48. So what will happen after that? Your 5 shares will become, each of which will become 48 rupees, and it will be 240 only. So you will have a loss of 10 rupees. And you can cover up that loss of 10 rupees by selling this right till this point to someone else. If you do that, you can say that my portfolio is of 240 and I have covered 10 rupees by selling the rights, and in total I have 250 rupees. But if you let the right lapse, you lose 10 rupees. It means that there was something in your hand which was having some value and you did not sell it, and that's why you lost the money. So this is all and all I can say the logic. Just a second. The logic of rights issue. Now coming over to the practical question, how we are going to calculate the market price. So there will be few things that we will have to calculate. For most of the time we will be calculating the value of right and X right price of the share. So there is a difference between value of the right. This is the value of right that you have received, and that is X right share price. So how to calculate the X right share price? It's very simple, sir. Have a look. Market price of the share is nothing but market value of the total company divided by number of shares. Am I right? So let's say, for example, 500 crore is the market value of the company, and number of shares are 10 crore. 500 crore is the market value of the company and the number of shares are 10 crores. That brings us to 50 rupees. So the market price right now is 50 rupees. We can call it as P0. Today's market price. And after the right issue, what will happen? There will be two things. You will raise additional funds from the market. Let's say, for example, if we take the situation, there are 10 crore shares, and what you did was you issued the right issue. The right issue was in the ratio of 1:5. So 10 divided by 5 means 2 crore additional shares you are going to issue. Am I right? 2 crore additional shares you are going to issue, and you are going to get 40 rupees for each share. That will be adding 80 crore in the bank account. So once 80 crore comes in your bank account, your market value will also increase by that amount. So practically speaking, after that, the market price will be calculated like this: market value plus funds raised. Am I right? Divided by total shares. So just imagine, after the right issue, the market value was 500 crore, right? Plus you have raised 80 crore rupees of the funds, and the total number of shares are 10 plus 2. Earlier it was 10 crore. Now 2 crores has been issued additionally. So it is 12 crore. So 580 divided by 12. 48.33. 48.33 is the X right price of the share. What is this? This is the price of the share. So that's what I was saying at that point. If you want to buy the share at this point, you will get it at 50 rupees. But if you want to buy after this date, you will get it at 48.33. Although you are getting it at a lesser price, but buying it at 50 rupees comes with a right. So you get a right to buy additional share, but this comes with no rights. So practically it's okay. 48.33 means without any right. So this is X right price of the share. Now coming over to the point, in the same situation, what is the value of right? What is the value of this one right if I want to sell it to someone else? If I want to sell it to someone else, at what price I should be selling it? For that purpose, I will have to calculate the value of right and how to calculate the value of the right. See, theoretically speaking, I got the right to buy the share and I don't want to buy the share because I don't have the money or I'm not interested in buying the shares at all in this case. But please understand one thing. If I don't buy the share after X right date, after this date, my portfolio will fall because I will be having same number of share before and after, but the market price will go down. When the market price goes down, my portfolio value goes down and I will have to suffer losses. That loss should be the value of the right, because that is how much I should be covering by selling the right, so that I am at no loss, no profit. So practically speaking, in this scenario, we had a portfolio of 5 shares at 50 rupees earlier. It becomes 250. But after that, we have 5 shares at 48.33 after X right date. And if we do not exercise in our right, so 48.33 into 5 comes to 241.65. That means 8.33. Am I right? 8.35 is the loss that I will be suffering if I don't buy the shares at a discounted price. And that much should be the value of the right. I will be interested in covering this much of the loss by selling this right to someone else. To whomsoever I will be selling it, don't you think I will be covering at least this much amount from that person? So this becomes the value of the right. The loss that you will have to bear for not exercising the right becomes the value of the right for selling it to someone else, so that the loss on one side gets set off by the profit on the other side. Okay, so how did you calculate the value of right? Sir, this value of right is calculated as X right price, we can call it as P1. X right price, we can call it as P1. So P0 minus P1, it was 50 minus 48.33. So that's not 48.33. We can say it like that, but we will have to multiply it with 5. Okay, before going ahead, let me just clear one thing. This value of right is based on 5 shares. Do you understand that thing? 8.35 is a difference between the value of 5 shares. So if I want to bring down the value of right to 1 share, I will just have to divide it by 5, so that I will get the value of right per share. Do you understand the difference between value of right in total and value of right per share? It's simple. Because you have been calculating the difference between the total, you are getting the total value of the right, value of one right. And this is value of right per share. Value of one right per share. You can say anything. So it will be 8.35 divided by 5, 1.67. And this is nothing but P0 minus P1. So 50 minus 48.33 will be 1.67 in a similar way. So this is how you can calculate the value of the right. There are multiple formulas to calculate the value of the right. I will just tell you. The first formula that you learned was P0 minus P1. So that's 50 minus 48.33. That goes to 1.67. Another formula. Okay. Another formula. These are the value of the right per share. See. Another formula. P1, the X right price, minus P1 minus subscription price. What it is going to get us is 48.33 minus 40 rupees divided by divided by your n. N means the number of share that you had in the beginning. So you had 5 shares in the beginning. If you had 5 shares in the beginning, it will be like this, 1.67. It will give us the same value. What was P1? 48.33, the ex-right price. And what is 40? The subscription price. What does that mean? When the market price of the share is 48.33, you are able to buy the shares at 40. That means whosoever is buying at this price is suffering a loss of 8.33 on 5 shares. 8.33 on 5 shares. So 1.67 ultimately it is going to be the same. So this is it. We are going to take some questions and I think we will be able to practice the formulas with this. Okay, before moving ahead, I should be opening up this formula book to let you know the formulas for right issue. See, this is the ex-right price of the share. Ex-right price of the share, that means 48.33 that we calculated. In this diagram, this is this price, the price after this date, the market price of the share after this date. So understand the meaning of the formula. N means the number of share that you had before right issue. It was 10 crores in the entire company. P0 means the market price before or at beginning. It was 50 rupees. Plus N1 means the number of additional share that you are issuing in right issue. So in 10 crore we were giving the ratio of 1:5. That gives us N1 to 2 crore. That means 2 crore additional shares we are issuing, multiplied by the subscription price which was 40 rupees. So this is nothing but 500 plus 80 divided by N means the number of share that was there before right issue, 10. In right issue, 2. So in total it is the same formula, 500 plus 80 divided by 12, that is 580 divided by 12, that is 48.33. Are you getting this formula? This is the market value of the company before right issue. Understand the logic, forget about the formula. Market value of the company before the right issue, additional funds raised in the right issue and divided by the number of share before right issue and additional shares issued. 10 plus 2. Okay, so you will get everything here. P1 is the ex-right price, P0 is the pre-right price. N is the number of existing shares before right issue. N1 is the number of new shares under right issue. So this is ex-right, pre-right, existing share, new shares. That is what you have to understand. This will give you the price of the share. But now what is the value of the right? I will talk about rights on and ex-right later on, but let's get to the point. What is the value of right? Value of right is very simple. First of all, I talked about this 50 minus 48.33. It was giving us 1.67. True. Then I came up with another formula, that was this, P1 minus S divided by N, number of share, and multiplied by N1 in the beginning. It was 1 only in our case, that's why I didn't take it. So N1 is the number of new share that is being issued, 1. P1 is the price. P1 is the price after right issue. So ex-right price 48.33 minus subscription price 40 and the number of existing shareholders shares 5. You can take it in total also, 2 by 10. 2 crore divided by 10 crore or 1 divided by 5. It's one and the same thing. 1.67. This is another formula. Have a look. It's very simple. See. And it has a logic also. What is happening is P0 means 50 and S means 40. That means a share which is worth 50 rupees right now and you are giving it at a subscription price of 40. That means the total discount that you are giving is 10 rupees. And on how many shares? For one share, if you have 5. N1 is the number of new shares. N1 is the number of new shares. N1 is 1. So we are giving 1 share for every 5. So this total 10 rupees of the discount has been given. Who is going to bear this loss? Equity shareholder itself. If the market price goes down, If the market price goes down, there will be a loss to the company, and who is going to bear the loss? The owners. And how many owners are there, or we can say how many number of equity shares are there after the X right price? 5 earlier and 1 additional issued. So 5 number of shares were there earlier and 1 more issued by you itself. So after a particular point, there will be 6 shares in the company. Understand? There will be 6 shares in the company who will be bearing a loss of 10 rupees, because you yourself, the company itself, gave a discount of 10 rupees. Who is going to bear that discount, that loss? Discount is a loss. Who is going to bear that loss? Company. So company will be bearing a loss of 10 rupees on 6 shares. That automatically becomes 1.67. So whichever formula you want to use, you can use it. The answer will be same. But this is the scenario when the rights on situation is there. That means if you are calculating the value of the right in this period, let me just mark it. This is a rights on period. You call it as a rights on, or you call it as a cum right. 1.67 was the price value of the right. In this period. Okay. That means if you want to sell that right to someone else, you can sell it at 1.67 per share. Per share. But obviously the right is going in whole, na? See. Let's say this is the right. So 1.67 is the price of the entire right? No, sir. This right issue has divided into, this right is divided into 5 parts. And 1.67 is the value of each part. And practically speaking, you cannot just tear it off and sell it to someone else. You will have to sell the entire right. That means when you are selling the right to someone, you are giving them a right on 5 shares. So when you will be selling this right, you will be collecting 8.33, 1.67 into 5, 8.35 or 8.33. So, and value of the right per share is 1.67 if someone asks you. But value of the one right, entire right, is 8.33. So at the time of selling, you will be selling this, not individual rights per share. Okay. So whatever I am saying here, I can say that 1.67 is the rights value per share, or 8.33 is the total value of the right. But in that period only, if you want to sell it to someone else, sell it at 8.33. But after that particular date, we will call it the value of the right X right. After the X right date. And the formula will change after that. Why the formula will change? Just understand. Whosoever is buying the share in this phase, they are getting a right to buy one more share at a discounted price. See, share 5, N1 1. That means if you have 5 shares, you can get one more, and then the total will be 6. But if you are buying the share after this date, then you can buy 5 share, but you will not get anything. So those who are buying the share in this particular phase, they will still have 5 shares. So the closing shares will be 5 only. This N1 will be 0. Do you understand? N1 will be 0 after the X right date. That means the same formula can be used here. N1 P0 minus S divided by N plus N1. But the main problem is after the X right date, N1 is 0. No new rights are given. So 0, 0. You cannot put 0 in the numerator. Mathematically it will go wrong, because it will become, the entire numerator will become 0. Right? So remove it from the formula directly. So the ultimate solution or the ultimate formula will be the same, P0 minus S by N. So after the X right date, if the market price is 50 at that time and the subscription price was 40, because subscription is still active, na? You can still subscribe till this date. Subscribe till this date. So 40 is still applicable. So still there is a 10 rupees of the discount and the current market price is 50. It can change. The market price on this date is very important. The market price, okay? So 50 minus, right now I'm taking 50 minus 40 and the number of share will be 5. 10 rupees of the discount will now be borne by all the 5 shareholders, five shares, and then the value of the rights will be 2. The value of the right has increased. The value of the right has increased. Practically it should have decreased, but this is just a theoretical answer, so that's why. Are you getting it? These are all the formulas. We are going to practice these formulas again and again so that we will have a good hand on it. So let's start with the question, sir. Question number 46. See, I just told you about this situation, and this will be covered in our first question. 1.67 was the value of the right. 8.33 is also value of the right. But what is the difference? This is the value of the right entirely. And this is the value of the right per share. So this is what the question is asking us here. Calculate the theoretical post right price per share and the value of the right alone. Have a look. Amco Limited is one company. It has 75,000 equity shares of rupees 10 each. So understand, 75 is nothing but N, means the number of existing shares. 10 is the face value. The current market price is 36. Can I say it is P0? Okay. The company has a plan to make a right issue of 1 equity shares at a price of rupees 24 for every 4 shares hold. So the ratio is 1:4 and the subscription price is 24. A share worth 36 can be purchased at 24 under right issue. You are required to calculate the theoretical post right price per share. Theoretical post right price. Have a look. Question number 46. What did they ask? Did they ask about the value of the right in the first part? No, sir. They are asking about the value price of the share. Price of the share post right. Just write down X right. So they are simply asking the X right price of the share. What will be the price of the share after X right date? In a diagrammatical term, they want to calculate the price of the share at this point, after this point. It was 50 and it was 48.33 in our case. So this is going to be the X right price. That is what we have to calculate. Okay. See. And use the same formula every time, because institute has used different formulas in suggested RTPs and the module also. So you will have to stick to one formula. X right price. Or I will just do it in the compiler itself so that it is very easy for you to understand. So in the numerator, we will take the pre-right market value plus additional funds raised divided by the number of shares, total number of shares. So it will be N number of shares before right issue, P0 the market price before right issue, plus N1 the number of new shares that you are issuing at a subscription price. So N1 into S divided by N plus N1. Am I right? The total number of shares. So the number of shares were 75,000 earlier. You can do it in the total also, and you can do it in 1:4 ratio. It will be one and the same thing. See, they have done it in 1:4 ratio. It gives you the same answer. So let's do it. Earlier 4 shares were there of 36 plus 1 share you are issuing in rights at 24. So you are raising a fund of 24 rupees. And after the right issue, X right date, there will be 4 plus 1, 5 shares in the coming time. So if you do the calculation, it will be 33.6. So the market price will fall for the share 33.6. See, it was 36 at this point and you made an announcement. After the ex-write date, it will be 33.60. So this is P0, this is P1. Are you getting it? Okay, that's cool. But what will be the theoretical value of the right alone? Theoretical value of the right alone. It's very simple. Again, use the same formula. Calculation of the theoretical value of the right alone. Unless otherwise given, we are going to consider it as come right price or rights on. So it has three formulas. First of all, please write down all the formulas. N1 in bracket P0 minus S divided by N plus N1. That means one share and it was trading at 36, you gave it at 24. That means 8 rupees of the discount will be distributed in 5 shares, N plus N1. It goes to 1.6. Am I right? 36 minus 24. 12. Okay, not 8. 12 rupees. 12 rupees divided by 5. It's 2.4. The other formula is P0 minus S. P0. What was P? No, not P0. It's P1. P0 minus P1. P0 minus P1. P0 was 36 minus the ex-right price is 33.60. Am I right? So it is going to be 3 or 2.4. Again, another formula. N1 in bracket P1 minus subscription price divided by P1 is how much? 33.60 minus 24 into N1 divided by N, existing number of shares. So P1 is how much? One share in bracket P1 is 33.6 minus 24 divided by 4 number of existing shareholders. The entire loss 33.60 will be the current market price and you will be selling it at 24. So 33.6 minus 24 divided by 4 is 2.4. Am I right about the formula? Let's just find out once again. The third formula. It is P1 minus S by N. When you do P0 minus S, you will have to take N plus N1, the additional shares also. But when you do P1 minus S, you will have to just take the existing shares, not the additional shares. Okay. So all the three formulas will give you the same answer in this case. 2.4, 2.4, 2.4. That is the value of the right per share. Have some difference. No, this difference. This is the value of the right per share, but this is available on 4 shares. So the total value of the right will be 9.6. And you can calculate it like this. 33.6 minus 24. 33.6 minus 24. That is the entire value of the right. And you are just dividing it by 4 to make it per share value. So 9.6 is the value of the entire right. It will look like this. So this is the right and you have divided it into 4 parts because 1:4 is the ratio. The value of every part is 2.40. But you cannot distribute or sell one part out of it. No? The right certificate is this and you will have to distribute or sell it entirely and that will cost you 9.6. So 9.6 is the rights value alone entirely. Or if you want to calculate it per share, it will be 2.40. Okay. I think this will be your homework because it's very easy. I will just take this one, question number 48. Have a look. Aggressive Limited is proposing to fund its expansion plan of 12 crore by making a right issue. So I told you the basic thing or the movement from where all the rights things start is the need to issue extra funds. Company needs to expand its business and it wants 12 crore rupees which it wants to issue through right issue. The current market price of the share is 40 and the board is willing to offer a discount of 20% on the current market price for the right issue. So what will be 20% after price? So what will be the price after 20% discount? It will be called as the subscription price at which the rights can be purchased. So in this case, please understand the question in exam will not every time give you the subscription price as a word and the amount for that. They will just give you another sentence from which you will have to find out what exactly that means. Understanding the concept will help you always. They want to give discount for the right issue. For what purpose? For subscription price. That is what the price. I told you the concept of right issue, that students means the customer means the equity shareholder. Existing equity shareholders can purchase additional shares at a discounted price. So that discounted price will be calculated after the discount of 20%. Am I right? So 40 less 20%, 8 rupees. 32 will be the subscription price. Am I right? This one. Okay. Then the board is also desirous that the fall in X-right price. They know that the X-right price will fall, but they want to make sure that the fall in the X-right price is not more than 10%. It should be restricted to 10% of the current market price. So 40 into 10% means 4 rupees. The fall in the share price after the X-right should not be more than 4. So 36 should be the X-right price of the share. In the previous question, they asked you to calculate the X-right price. In this question, they are already giving you the X-right price, that it should not be more than 10%. The fall should not be more than 10%. Now, the question is asking you the ratio. Please understand, the entire question has been finished and they have not yet given in which ratio the rights issue has been declared. So now they are asking you the number of new equity shares to be offered for each rights held. For one right, how many shares someone can purchase? Okay. So let's calculate it. It's very simple. You just have to put down the formula. What is the formula for X-right price? X-right price is P1, which is equal to N into P0, the pre-market value, pre-right issue market value, plus N1 into subscription, the amount that you are raising through right issue, and N plus N1. So N1 is the number of share. This N1 and this N1 is the number of share that will be issued, and that is what the question is asking you to calculate N1. How many new number of shares you will issue for this much? So have a look. So if I take 36 P1, how much is the P1? X-right price should not be less than 4 rupees, no? Should not be more than 4 rupees. So 40 minus 4 is 36 P1. N, let's take it 1 for every 1 share. P0. We can calculate the ratio. If N1 comes into decimals, now we can calculate the ratio later on also. What is P0? 40. N1 we have to calculate. Subscription price is 32 and 1 plus N1. Am I right? So I have taken the number of existing shares as 1. On that particular figure, whatever will be the N1, we can easily calculate the ratio after that. So if I solve this, it will be 36 plus 36 N1 is equal to 40 plus 32 N1. So I will take N1 on equal side. It will be 36 N1 minus 32 N1 is equal to 40 minus 36. It goes to 4 N1 is equal to 4 and N1 is equal to 1. That means for every 1 share, for every N is equal to 1, for every N is equal to 1, N1 is also 1. So the ratio, right issue ratio is 1:1. For every 1 share that an equity shareholder is holding, he will get a right to buy 1 more share at a discounted price. So the answer comes to 1. The answer comes to 1 equity share to be offered for each share held. The ratio is 1:1. Clear? Second thing. The second thing that they are asking is the theoretical value of right, and we have three different formulas for it. Three different formulas. Please, without looking at anything. First formula. Arey yaar. First formula. Very simple. N1 in bracket P0 minus S divided by N plus N1. Second formula. P0 minus P1. Third formula. N1 in bracket P1 minus S divided by N. Use any of it and you will get the same answer. To be very simple, this one is going to be our formula in this case. So P0 is 40, P1 is 36, the answer is 4. 4 is the value of the right. Each right per share. So in this case 1:1 is the ratio. So the value of the right becomes 4. Value of right per share also becomes 4. Third, the total number of equity shares to be issued. How much of the funds that you want to raise? 12 crore. So write down 12 crore. And at what price? 32. By selling one share, you will be getting 32 rupees subscription price. So how many number of shares have to be issued in order to raise 12 crore? 12 crore divided by 32. Okay, 37,50,000 shares have to be issued, and every share will be sold at 32 rupees, the discounted price, so that we can get 12 crore rupees. Okay. This is going to be your homework. Let's have a look on question number 50. Something different. ABC Limited share are currently selling at rupees 13 per share. I think the first two part of these two is also same. The third one is only different. Okay, let's continue with this. So the current selling price is 13, which is P0. There are 10 lakh shares outstanding. We can call it as N in this case. The firm is planning to raise 20 lakh rupees to finance a new project. They want 20 lakh rupees. Calculate the X right price per of the share. Just make it P1. In this case, or I can say this much is P1, and the value of the right is different, that is V0 or whatever you want to say. In this case also X right price of the share and the value of the right. So what is the difference between both of them? The ratio is different. Here the ratio is one right share. Have a look. One right share for every 2 shares held, and here one right shares for every 4 shares held. So the only difference in the first and second part is the ratio, 1:2, 1:4. In both the cases we have to calculate the value of the right and X right price. You just put down the formula and you will get the answer. Very simple. When 1:2 is the ratio, what is the value formula for X right price? Again, repeating the same thing. Please try to remember. N P0 existing value and additional amount, that is N1 at subscription. You should understand or remember the formula like this. The number of share multiplied by the market price will give you the market value, and N1 is the number of new shares that you will be issuing at subscription price. So you will be getting this much of the amount subscription price from every share divided by N plus N1. So in this case 2 existing shares into 13 plus 1 into subscription price. Okay, we will have to calculate the subscription price first. So understand, there are existing 10 lakh shares. 1:2 is the ratio. That means how many new shares will be issued? 10 lakhs divided by 2. That is 5 lakhs. And you want 20 lakh rupees from 5 lakh shares. So 20 by 5, if you will do it, your subscription price comes to 4 rupees. Very small, whatever it is. So the subscription price comes to 4 rupees in this case. Are you getting it? You can calculate the subscription price. Subscription price is nothing but the amount that you want and the number of new shares that you have that you want to issue. So 20 lakhs divided by 5 lakhs, that means 4 rupees from every shares will bring you 20 lakh rupees, divided by 3, 2 plus 1. This way you can calculate the X right value. This is the subscription price, 4 rupees. 4 rupees is the subscription price. It should have, the heading is not proper. The first point is something else, the second point is something else, but there is some difference in here. So this is the subscription price of 4 rupees. X right price is this. Let's calculate it. 13 into 2, 26 plus 4, that is 30 by 3, that becomes 10. This is 10. They have taken it in whole number, understand? They have taken it in they have multiplied the price with the total number of share. Do not do this, the answer will be same. So that's why try to make your calculation as short as possible. Then the value of the right is very simple, sir. You can just calculate P0 minus P1. P0 was 13 and P1 was 10. So 3 rupees is the value of the right. You can do it like this. Okay. In the second part also you are going to do the same thing. The only difference is you are now going to issue one share for every 4. So 10 lakh divided by 4 means 2,50,000 shares will be issued. And if you want 20 lakh rupees from 2,50,000, your subscription price will get changed to 8 rupees per share. And now calculate both the things. So again, if you will do it, the price of the share is 10, value of the right is 3. And here the price is 12 and the value of the right is 1. That's it, simple. Third part is more important because the first two part are like just put down the formulas, values, and you will get the answer. Analyze how does the shareholders' wealth change from 1 to 2 above, and right issue increases shareholders' wealth. First of all, there will not be any change in the wealth of the shareholder. It doesn't matter what the ratio is. The wealth of the shareholder will remain same. Have a look. The effect of the right issue on wealth of the shareholder who is holding, let's say, 100 shares. Just take an example. Let's say, for example, someone is holding 100 shares. So in the first case, he will be getting 50 more shares, 1:2. Am I right? 1:2. So value of the shares after right issue. Okay, right. So if he is holding 100 shares, in right, he will be getting 50 more shares. So his total number of share will go to 150. Okay. After the right issue, what will happen? The share price will come down to 10 rupees. It was 13 rupees. It will come down to 10 rupees, right? So 150 into 10 will be his portfolio value, which will be 1500. Right? Good. Plus, these 50 shares have not been acquired free of cost, right? You have paid something for that. What was the subscription price? 4 rupees. So 50 into 4 was the subscription price. Your portfolio has become 1500. For that you have paid 200 rupees. So the net value or the net wealth to you is 1300 only. I will give you another way of explanation, because I am not satisfied with the explanation that I just gave you, because it was just reading that thing. Okay, so let's say that you have 100 shares. Okay, 100 shares, and you have 100 shares and you are adding 50 more shares to your portfolio. But for that purpose, you will have to pay for that, and you are getting one share at 4 rupees in right issue. So you will be paying 200 rupees from your pocket. So now you have 150 shares. But after the right issue, what is going to happen? Every share will become P1, right? After the right issue, this is N, this is N1, and this is N plus N1. After the right issue, every share will be priced at 10 rupees. So the total wealth for you will be 1500, and you paid minus 200 for that. So net wealth for you is 1300. Now let's take another example, or the second situation. You had number of shares 100, and how many number of new shares that you have received in the second example, the ratio was 1:4. That means for every 4 share, one right issue. So 25, 100 divided by 4. But you will not get it for free. Again, I'm telling you, you will have to pay the subscription price for that. And the subscription price for that was 8 rupees. See, subscription price in the second part was 8 rupees. So you will pay 8 rupees, that again goes to 200. Now this will become 125 n plus n1, and you will 125 only, and you will be valuing this at P1. What was P1 at that time? P1 was 12 rupees in the second case. So the X-rate price was 12 rupees. If you do the calculation, it will again come to 1500, and you paid 200 for that, and your wealth will be 1300. So the conclusion is that the wealth of the shareholder does not change from 1 to 2. Although the ratio was different, 1:2 and 1:4, it doesn't matter at all. Okay, that is the scenario. Thus, there is no change in the wealth. It was very easy. Okay, let's come down to the next question, question number 51. Question number 51 is also simple. The only thing that is different is this third part. So let's just read it and we will complete it quickly. The first two part will be the formula thing only. So it has issued 90,000 equity share. This will be N for us. Of rupees 10 each, this will be face value. Current price is 72, which is P0. And they want to issue 1 new equity shares for 4. So the ratio is 1:4. And at 48, that means this is going to be the subscription price. So we have P0, we have S. Okay. And we have the ratio also. We can easily calculate the theoretical post-write price. It's very simple. Have a look. N P0 plus N1 subscription divided by N plus N1. So N, that means 4 shares into P0. P0 is 72 plus N1 1 share at 48 divided by 5. So you will get an answer. 72 into 4 plus 48 divided by 5. So 67.2. Let me just check. 67.2 is your P1. Write it down. P1, 67.2. What is the theoretical value of the rights alone? If you want to do it, it's P0 minus P1. That's 72 minus 67.20 per share. But this is going to be per share. 72 minus 67.2 is 4.8 per share. Another way is simple. Simply you can do it like this. P1 minus subscription price. So 67.20 minus subscription price 48. 19.2. Rights alone is 19.2 entirely, and 4.8 is per share. So both the answers are right. 4.8 is also right. 19.2 is also right. You need to understand the difference in 4.8 and 9.2. 19.2. I will just again repeat it so that there is no confusion. This is the right. Okay. The value of it is 19.2. The only difference is it was issued on 4 shares. So 4.8, 4.8, 4.8 and 4.8. 4.8 is also the right value of the right. 19.20 is also the value of the right. So 4.8 is the value of the right per share, and this is alone entirely. Now the third part, which is why we took this question. Suppose Mr. A, who is holding 100 shares in KLM Limited, is not interested in subscribing to the right issue. He is not interested. Then what should he do? There are only 3 things a person can do. He can subscribe, he can sell it to someone else, or he will let it lapse. So what advice you will do? You will give it to him. The advice that you will give to him is sell this right to someone else. Do not let it lapse. If you let it lapse, your portfolio value you will lose on your portfolio. So I think there will be some sentence. If Mr. A is not interested in subscribing to the right issue, he can renounce his right eligibility at 19.20 per right and can earn a gain of 480 rupees. See how 480 rupees, I will tell you. 19.20 per right. Per right was on 4 shares. Right? 1 right on 4 shares. So if you say 1 right on 4 shares, the value of the right is 19.20 here, and the value of right here is 4.80. So either you multiply 19.20 with the number of rights that you have received, or you multiply 4.80 with the number of shares that you have. You will get the same answer. Okay. If you have 100 shares, the number of rights that you have received is somewhat like 25. So 19.20 into 25 or 4.80 into 100 will give you same answer, 480. You should understand the difference like this. Got it? Only advice that you should give to someone who is having the right is sell it to someone else. Do not let it lapse. This is again the same question and I'm leaving it to you. Same question. The only difference is if he sells the entire right, we will have to show the wealth of the shareholder. It does not change. But if he does not take any action and ignores the issue, there will be a loss to him. That's it. The wealth does not change here if he sells the entire right, but if he let it lapse, there will be a loss to him. See, there is no change in the wealth and there will be a loss of wealth of 1600. That's it. Just do it. See, if you do not do anything, earlier you had 1000 shares at rupees 24 and the market price now has fallen. So 1000 shares at 22.40 becomes 22,400. You could have sold the rights and earn 1600 here to make the portfolio wealth as it was before. But you did not you did not sell that share and sell that right, and that's why you are suffering the loss. So I'm telling you that thing. There are only three things. If you sell the right, the wealth will not be decreased nor increased. But if you let the right lapse, there will be a loss to you. Now is an amazing question. I think one of the most difficult one in the entire right issue thing. Not that much, but it is going to be an interesting. Let me see if more questions are there. Question number 53, 54, 55 is interesting. Oh, only 3 to 4 questions are there in the right issue and we will just finish with this entire topic. Okay, let's continue with this. Question number 53. Okay, have a look. The stock of Sony PLC, this is a company selling at £50 per common stock. The symbol is of pound. In this is a UK currency. So right now the stock is selling at £50. Let's mark it as P0. The company then issues right to subscribe to one new share at £40. This is subscription for each 5 rights held or 5 shares held. It should have been 5 shares held. So it should be like this. The ratio is 1:5. So if you have 5 shares with you, you can buy one more share at £40. What is the theoretical value of right when the stocks are selling rights on? This is something for the first time they have asked us calculate the value of the right when the rights are selling rights on. And let me tell you one thing. Till this point, all the value of rights that you have calculated was deemed to be rights on. In this question itself, they have asked us separately to calculate it by giving a proper wording for it. Otherwise, we were doing the same thing. Second question. What is the theoretical value of one share? Value of one share when it goes X right. So this is basically X right price, P1. Third part. What is the theoretical value of the right? Again, they are asking the same thing which they asked in the first part, but now they are saying when it sells X right at £50. So this is something different. X right. X right means if it is selling at X right means the market price, the current market price is £50. Also, it was 50 only at that time. And according to me, practically, it should have been lesser than 50. But I don't know why they have given 50 itself. But let's take it 50 only. If they would have given somewhere like 46 or something, we would have taken 46 at that time. So 46 minus 40 would have been the answer. But now it will again be the same thing. Okay, let's come down to the formulas. Value of the right is nothing but P0 minus P1. As usual, 50 minus 48.33. Let me clear one thing to you. What is the value of the right? 1.67. And in our example, this is the value of the right in this period. Getting it? This period, 1.67. Okay. Then comes the X right price. This is the same formula that we are supposed to use in the X right price, and the X right price is 48.33. You can see that the example that we took in the first place while explaining the concept was same, like the number of the ratio or the current price and the subscription price, everything is same in this question. So it's very easy for you to now understand what is being happening here. But now comes the third part. The value of the right when the stock sells X right means you have to calculate the value of the right in this period, X right period. At that time, what is going to happen? If you buy 5 shares, there will be no new shares issued. So at that time, the price will be simply P0 minus S by N. Otherwise, it was P0 minus S into N1 divided by N plus N1. I told you that when it goes X right, the N1 becomes 0. We cannot put 0 in the numerator. So remove it from the formula and it will become like this, P0 minus S by N1. So the total loss is 10 rupees right now. The 50 share is selling at 40 rupees. So the total loss is 10 rupees, which will be borne by the 5 shares in total for one right. So value of the right becomes £2. Fortunate, we can say technically it should have been lesser than 1.67 technically, because this 50 would have gone down to, let's say, 46 practically, and 46 minus 40 is 6 rupees divided by 5, 1.33 or 1.167 would have been the value of right practically. But let it be this 50, please, ladies and gentlemen, this 50 is this price, not the P0, that price when the stocks is selling X right at 50. So imagine it like this, it is 50 and here also it is 50. So which 50 has to be taken in the example? If we want to calculate the right price at this point, we will have to take this 50. Getting it? Okay. So you have reached at the 3 different points: value of the right, X right price, and again value of the right. The fourth one is interesting. Have a look. John is the speculator. Now, what do you mean by the speculator? Speculator is someone who takes the risk. Underline this word and write down. Who takes risk for earning profit. Risk means he can have losses also. He is taking the risk for earning the profit, but he may end up in losses also. So that's what the risk is. So John has £1,000 at the time Sony PLC goes X right at £50 per common stock. When the stock went £50, the price was £50 in the market, and at that time John had £1,000 with him. He feels that the price of the stock will rise to £60 by the time the rights expire. See, imagine a situation here. John is standing here and the market price of the share is £50. Okay, market price of the share is £50. Now he thinks that at this particular point he has £1,000 in his pocket. He thinks that if he buys the share, it can go up by the time the stock expires. So at this date, the price of the stock can be £60. So it is better for him to buy the shares, right? Buy it for 50, sell it for 60. There will be a profit of 10, particularly £10 on every share. So buy any number of share. How many number of share that you can buy today? See, if you have £1,000 with you and the price is 50, you can practically buy 20 only. 20 shares. Okay, good enough. You can buy 20 shares today and you can sell those 20 shares at £60 at the expiry, and the profit will be £10 on each share, 50 to 60, and the total profit will be £200. In this case, if you buy the share and then sell it, the profit will be 200. Okay, what is the question asking us? Have a look. Compute He feels that the price of the stock will rise to £60 by the time the rights expire. Compute his return on his £1,000. We have to calculate the return that he have earned on £1,000. If he buys Sony PLC stock at 50, this is what the situation that I just told you, that if he is buying the stocks at X right date and selling it when the rights are expiring, so he can close the deal by selling those 20 shares at 10 rupee or 10 pound of the gain. The total gain will be 200. His investment was 1000. He can clearly say that I have earned 20% on my investment if he buys the pound. But instead of, if he buys the stock, but instead of buying the stock, if he can buy the rights from someone else at this point, he can also buy the right. Now see, suppose you are the shareholder and you have the right of this share, you can sell those rights to John, and not only you, I can also sell it to him. So what he will do on the X right date, he will collect means he will buy rights from everyone worth 1000, because he only has 1000 £1,000 with him. And remember, on this date, on the expiry, on the X right date, the rights value was £2. So the price of the right, the value of the right on that date was £2. If he wants to buy the rights, he can buy almost 500 rights on that date. Almost 500 rights on that date. But he will have to sell all those rights before, understand, before this date, selling date. I will just remove all this because I don't want to mess up with the concept. 2. The question is, see, you will have to calculate the gain if he buys the stock at £50. Otherwise, there is another option to do. What to do with £1,000 is buys the right at the price computed in part C, which is 2. See, part C is £2, assuming his price expectations are valid. If his price expectations are valid, the price at the expiry of the right will be £60. I will tell you now how everything is going to happen. Just to make it clear to you, this is the announcement date, this is the X right date, this is the opening date, and this is the closing date. Okay, this is announcement. I will just write it down. This is the X right date, this is opening date, this is closing date. Closing is also called as expiry. Okay, right now the price of the share is 50. It was supposed to fall down to 48.33, but in actual it was 50 only. The question is itself saying that the price, X right price is 50. Then the price on the expiry of the right will also be rising and it will become 60. That is what the situation is right now. Now, in this period, in the first part, we calculated the value of the right is 1.67. But in this period, the value of the right is £2. And if we are buying in this period, the X right period, we can buy it at £2. Now, John has £1,000 with him. What he can do with this is he can buy stock, or he can buy instead rights from other people who has the rights. Okay, who have all those rights. So buy stock means you will have to pay £50. If you want to buy one stock, you will have to pay £50. But if you want to buy right, you will have to pay only £2. Isn't it? In total, you will be having 1000 divided by 50, that means 20 stocks. But if you buy the rights, you will have 1000 divided by 2, that means 200 rights. And at expiry, you will be selling those. So if you have purchased stock, you will sell the stock. If you have purchased the right, you will sell the right. Right? And yes, please understand one thing. You will have to sell the rights somewhere on the selling date. Right now, nothing related to the selling date is given in the question. That's why what we are assuming is that this is the only selling date. The expiry date is only the selling date, last date of selling the rights. Okay. When the market price of the stock will be 60. So at expiry, we will sell stock 20 into 60 and we will get around 1200 pound. How much was the investment? 1000. How much is the redemption? 1200. Okay. In the second case, we will sell rights. At that time, we will have to calculate the right price, the price of the right. How to calculate the rights value? Value of the right at that time will be using the same formula, price minus subscription. You can clearly see at that time, while selling the right, the market price of the stock was 60. Market price of the stock was 60. And subscription price was 40. So practically speaking, people were buying, those who has the right, were buying the stock at 40 pound when the market price was 60. See, at this time, let's say for example, we are considering this time. This time the price was 60. So those who does not have the right were buying the shares at 60 pound, but those who were having the rights were buying the share for 40 pound only. So practically speaking, at that time there was a loss or a discount of 20 pound. Whosoever was buying at 60 pound. So that was the worth of the right on 5 shares. So 20 by 5. So at that time, the right value went up to 4. And it is very simple. See, when you were here, you calculated the rights value as 50 minus 40 divided by 5. When you are here, you will calculate it the same way, 60 minus 40 divided by 5. When you were here, you were calculating it the same way, 50 minus 40 divided by 6. Why 6? Because in this range you would have received one more share. Along with 5, you were getting one more share. So that's why in denominator it became 6. Here in the denominator it was 5. Here in the denominator it was 5 because the x-right date has gone. But before x-right date, the denominator will be 6. Otherwise, the numerator is same. 50 minus 40, 50 minus 40, 60 minus 40. So at that time, the value of the right went up to 4 pound. So just imagine you are buying it at 2 pound and selling it at 4. So what will happen? You will sell those rights. How many rights? 200. And you will have around 4 rupees value for every right. So you will be, sorry, this is 500. 1000 divided by 2 is 500. So you will be selling all those 500, just understand, 500 rights at 4 pound and you will be getting 2000 pounds. So how much money you invested? 1000. How much that you redeemed? 2000. The gain in this case is 200 pound. The gain in this case is 1000 pound. It's better to go this way, by buying the rights and selling it later on. And the question is very simple. To summarize, it was like this: 20 stocks bought at 50 and sold at 60. The calculation is like this. And 500 rights sold at 4, bought at 2. The gain is 1000. That's it. Getting it? This is what is given in here. Understand? If you buy the stock, you will buy 20 stocks and you will sell it at 60 pounds. So it will become 1200. And then the profit is 200. Number of rights purchased at the beginning is 500. And you will be selling it at 4 because the value of the right at that time will be 4. So 4 into 500 will be 2000. 4 into 500 will be 2000. So the profit is 2 pound on every right sold. Profit is 1000. So it is better to go this way than to buy the stock. Buy the rights and sell it in the market. You will be profiting. And this is pure speculation. I was just buying the rights and selling it to someone else. That's it. I did not want to buy the shares under that. I was just speculating. That means I was risking my money to earn the profit, and fortunately I earned it. Question number 53 is completed. Question number 54 is going to be the next question. So, welcome back after the break. This is going to be an interesting question. Let's have a look on this. Telbel Limited is considering undertaking a major expansion and immediate cash outlay of 150 crore. So there might be some mistake in framing the question. What all they want to say is 150 crore will be required. 150 crore rupees is required for this plan. The board of director of company are expecting to generate an additional profit of 15.30 crore after a period of 1 year. Underline this. After a period of 1 year. Further, it is expected that this additional profit shall grow at a rate of 4% for indefinite period in future. So what exactly we are going to achieve with this? Perpetuity formula will be applicable. I will tell you why. In order to calculate the present value of future cash flows. So before moving further, let me just explain this to you. Question number 54. Here there will be a cash outflow. Present value of cash outflow will be 150 crore. In this project, if you want to invest, you will have to pay 150 crore. Okay, but what will happen after that? Once you do the investment, after 1 year you will start receiving 15.30 crore, and this will grow at a rate of 4% and perpetually. So the growth rate here is 4%. What exactly we want to calculate is the present value of all the future cash flows. So value of the perpetuity, present value of cash inflow will be this much, which will be calculated with this formula. Perpetuity value is the cash flow received in first year divided by cost of equity minus growth. Understand that we want to calculate the perpetuity value here. That's why we need a cash flow for the next year. And the question clearly says that 15.30 is the next year's cash flow after a period of 1 year. It includes growth. You should not add a further growth in this. Okay. Just a second. Okay. So 15.30 crore includes the growth. 4% is the growth rate. The only thing which is not given here is the cost of equity. With the help of this particular formula, we will be able to calculate the present value of all the future cash flows, which will be called as present value of cash inflow. So let's say a figure will be arrived here of somewhat, let's say 170. At that time, we will be able to analyze this entire project in a manner that the outflow is 150, inflow in present value terms is 170, whether we should take the project or not. Yes, of course, we should take the project because we can clearly see a benefit of 20 crores in present value term. If the investment of 150 today is resulting into an inflow of 170 today, it's a good project. NPV here comes to positive, so we should accept the project. But everything depends upon the cost of equity. It can go negative also. Okay, we will just leave this space for further calculation. Now, the point is to calculate the cost of equity, and the second paragraph will help you to calculate the cost of equity. Have a look. Presently, Telbel Limited is completely equity financed and has 50 crore shares. This will become N, number of existing shares, with a face value of rupees 10 each. The current market price is 22.60 cum dividend. Understand that this is cum dividend. I will just tell you about it. This is P0 but cum dividend. The company has just paid a dividend of 1.40 per share in last year. So if you will calculate, what happens is the price here is 22.60 and the dividend is 1.40. Practically speaking, this dividend relates to the previous year, and just after the payment the market price goes down, falls. So this P0 of 22.60 is not at all useful for us. All the time we have been using P0, it was X dividend. It was deemed to be X dividend. If it is not X dividend, it should be given in the question, and that's what is given in the question, that it is cum dividend. So what we are going to do here is we are going to convert P0 into X dividend. And how we are going to do that? It's very simple. 22.60 is the cum dividend price, deduct dividend from that. So the X dividend price will be 21.20. Okay, understood. Now let's move ahead. The company has paid a dividend of 1.40. Has paid, that means this is D0. Okay, good enough. We have P0, we have D0, 1.4, and we also have the growth in the dividend. Earlier the growth of 4% was in this project, the cash flows, but this is the growth in the dividend, which is 6% given here. And it is expected that it will continue in the future. The growth rate shall not be affected by the expansion project in any way. Now with the help of this data, we can calculate cost of equity. Do you remember this? This entire data, just mark it and write down cost of equity. Next time you will be revising that entire mark of the entire coverage of the paragraph will remind you that this is only for maximum part of this is for the cost of equity. So how can we calculate the cost of equity? Using Gordon's model. Understand, market price 0 is equal to D1 divided by cost of, okay, D0 1 plus growth divided by cost of equity minus growth. So if you take the cost of equity minus growth on that side, it will look like this. D0 1 plus G divided by market price. And if you take the growth back to this side, it will be cost of equity is equal to, so put down the figures, 1.40, 1.06 is the growth, market price is 21 point how much? 20. X dividend, please understand, you are calculating the present value of future cash flow. So never take the past dividend in the market price. This market price is always the present value of future dividend. So taking the past dividend in this will go wrong. Plus growth rate. This way we will be able to solve it. The answer is 13%. Okay, you reached at cost of equity. You just put down this in here. 15.30 is already crowd is already CF1. 13% minus 0.404. So 15.30 divided by 0.09 gives us 170. I knew the figure, that's why I told you 170 at the time. So practically speaking, what practically speaking means? So the NPV of the project is 20 crore. The very first question in this sub-question in this question is whether we should accept this project or not, and the conclusion is yes. Why yes? Because while investing 150 crore, by investing 150 crore today, we are getting 170 crore in today's term. And how did we calculate 170 crore? By discounting all the future cash flows. 15.30 divided by cost of equity minus growth. So it is giving us 170 crore. By investing 150 crore, we are increasing the value of the company by 20 crore. So the present value of the cash inflow is 170. Okay, satisfied with this? Now, this is the answer to your first part. Whether it is worthwhile to undertake the project or not. Yes, it is worthwhile to undertake the project. Come to the answer directly. I will just show you. This is the cost of equity 13%. NPV of the project 170 minus 150, 20 crore. It is worthwhile to accept the project. So the first part is over. Okay, let's move ahead. Now coming over to the question. We wanted 150 crore to invest in this project. The main thing is from where we are going to raise this fund. Question says we have two options. We can issue right shares in the ratio of 1:5 at a price of 15 per share. Understand this. at a price of 15 rupees per share. Subscription price. Subscription. So 150 crore divided by 15. From every share you are going to get 15 rupees. How many new shares will be issued? 10 crore, sir. 10 crore shares will be issued. And at present we have 50 crore shares. So 50 crore is N, 10 crore will be N1. Okay, sir. 1:5 is the ratio. 1:5 is the ratio of right shares. So 50 by 5 will be 10. Exactly. It is coming to the same thing. So we can raise that 150 crore by issuing right shares or by issuing a fresh issue of equity share or a public issue of equity share. So this will be done at the market price. This will be done at some subscription price, which is 15. Okay. In both the cases, the dividend shall become payable after 1 year. You as a financial consultant are required to, I am just coming directly to the second point, calculate X dividend market price if complete expansion is financed from right issue. So they are just giving us the first option. If we entirely finance the 150 crore project from right issue, then what will be the market price? This is P1, X right market price, we can say. Let's calculate. It's very easy, sir. Second part. What is P1's formula? N into P0 plus N1 into subscription price divided by N plus N1. That's it. Simple. What is N? 5 shares. P0, the current market price, which is 21.20. Do not take the past dividend in that. Plus new shares 1. Against 5, only 1 share is issued. Subscription price 15. And the total number is 5 plus 1. So it's oh, there will be a problem in this case, right? We cannot use this formula. I will tell you why. Let me take the total number. This will be more clear. So the total number of existing share is 50. The new number that will be issued is 10. Am I right? 10 crores. And in the denominator, it will be 50 plus 10. So 21.20 into 50 gives us 1060 is the current market value of the company, and 150 crore is the amount that we are raising from right issue divided by 60, and it gives us 20.167 or 17 as the market price, which is wrong. Sir, how come this is wrong? We have been using this formula since last few questions, and now you are saying that this formula is wrong. Sir, this formula is not wrong. This formula is not applicable at that time in this question. Why? Because of one major reason. See, I will tell you. Actually, it will be like this. N into P0 plus N1S plus NPV divided by N plus N1. So it will be 50 into 21.20 plus 10 into 15 plus 20 is the NPV divided by 60. So 1060 plus 150 plus 20, that is 170. 20.5. This is the correct answer. Now you understand the difference. I had to take that extra value. Why? Because first of all, the logic of the numerator in the formula is the total market value of the company. It's not just NP0 and N1S. Okay. It is the total market value of the company. This formula also gives us the total market value of the company, but in this question there is some additional information which is increasing the market value of the company, that is NPV. Although you are investing 150 crore from the company, let's say you are investing 150 crore, so 150 crore is being wiped out Cash has gone out of the company, 150 crore has wiped out, but it is bringing back 170 crore. So you add 170 crore at that time. So in 1060, you should not add 150 crore, you should add 170 crore, because the market value is also increasing by 20 crore because of the NPV. The company's market value is being increased by 20 crore. So that also has to be considered. All the people in the market knows about this. Now, investors in the market knows that 20 crore will be additional benefit, and automatically that will impact the market price. That's why this is going to be the true figure in this question only. Whenever you feel so, you can change the formula. The logic of the formula in both the cases, we should take the market value of the company. And in this question, this is not just the market value, 20 will also add up to the market value. Do you agree with me? Let's move ahead. 20.50 is your price is your X right share price after issuing all the funds from right issue, only right issue. Third part is quite interesting now. Have a look. Calculate the number of new equity shares to be issued. Sir, new equity shares to be issued are 10 crore now. No, there is something else which is given here. Instead of 10 crore, we will have to calculate something else. Calculate the number of new equity shares to be issued and at what price, assuming the new shareholder do not suffer any loss after subscribing to new shares. See, if we go directly through the second option, I think basically they want to talk about the second option. If we directly go through public shares, public issue of the shares, we will be issuing new shares in the market. Question is saying, beyond 50 crore, how many new shares has to be issued? First of all, how many new shares has to be issued? And second, at what price we should issue, so that after the issue, the market price of the share should not fall. If it falls, then there will be a loss. Even though if it falls, there should not be any loss. They should not suffer any loss after subscribing the new shares. What they all want to say is like this. Now what is going to happen? Let's say this is a company. Okay. This is a company, and after this issue, the company's market value will be same. It is going to be this much: 1060, 150 and 20. 1060 is the current market value, 150 will be the contribution, and 20 will be the addition as NPV. So total market value will be that much: 1060 plus 150 plus 20, that is 1230. So 1230 will be the market value of the company. Okay. Right now there are 50 crore shareholders at a current price of 21.50, 21.20 market price, and they are contributing to 1060 crore in the total market value. Now what we are doing is we are going to add new shares. Let's say N. We are going to add new shares, issue new shares to the public, and we will be issuing it at some price. So we will call it as issue price. Okay. Through this, they are going to contribute 150 crore. After that 150 crore contribution, we are going to invest that 150 crore, which will add 20 crore in the NPV. So this 20 crore will be added, and this way the market value of the company will become 1230 crore. Do you agree? Okay. Now, after all this thing, what will be the market price of the company? Market price of the shares of the company, 1230 divided by 50 plus N. Do you agree? Because total market value is 1230 and the total number of shares is 50 plus N. Okay. So this will be your, let's say P1 after issue market price. Okay. This P1 will be multiplied with, this P1 will be the price of the share for existing shareholders and for the new shareholders as well. Because both has same type of shares, the price will be same for both of them. Existing shareholders, P1 multiplied by the number of shares, that is 50, will be P1 into 50. and the new shareholders total wealth will be P1 multiplied by N, the number of share, it will be N into P1. So this is the wealth of the shareholders. Question says that since the new shareholders are contributing 150 crore, the after contribution wealth of the new shareholder should not be less than 150 crore. These guys should not suffer any loss. That means this wealth should not be less than 150 crore which they contributed, because even a single rupee shortfall will be resulting into the losses for these people. So NP1 should not be less than 150 crore. Do you agree? It should be 150 crore. And what is that? The market price. See, NP1 should be equal to 150. Understand? N into P1 should be equal to 150 crore. Do you agree? This is the condition, that after issue market price of the company and the number of shares of the new shareholders should be equal to 150 at least. Okay. Now let's find out how did we calculate P1. I will just keep N here in bracket. I can write down 1230. Can you see this? See this? P1 can be replaced with this 1230 50 by N. So 1230 divided by 50 plus N is equal to 150. Do you agree? N is the new number of shares and this whole bracket is P1, the price after the issue. Okay, let's multiply. I will send that 50 plus N on that side. So N 1230 is equal to 7500 plus 150 N, and 1230 minus 150 is 1080 N is equal to 7500. So N is equal to 6.9444. This much number of shares, crores, I will have to issue. First part is solved, that I will have to issue this much number of share. How many? 6.9444 crore. And at what price? It's very simple. 150 divided by 6.944, the issue price will be calculated. So issue price is equal to 150 divided by 6.944, 21.60. Simple. So this is going to be the issue price. Let's analyze it again after all the calculation. Are we correct? 6.944 into 21.60. Now let's see. The total market value is 1230. Do you agree? And the total number of share is 56.944 crores. This will give us the market price of 21.60. And if you multiply this market price with their own share only, new shareholders' wealth will be 150 crore. So you can clearly see that we have maintained their wealth. Whatever they have contributed, we have maintained their wealth, and it's very simple. In the compiler, what you have to do is, see, they have given so many things here. What you can simply do is, in this case, what you can simply do is write down step by step. This is it. This was the one I was talking about. Yeah, I just wrote it like this. N in bracket, first of all I will write down N into P1 should be equal to 150. Then N in bracket, P1 is calculated as 1230 divided by 50 plus N is equal to 150. Then we will solve this. So it will become 1230 N is equal to 7500 plus 150n, and n is equal to 7500 divided by 1080, and this will give you 6.9444. And once you calculate 6.94144, you can calculate the market price also, or the issue price. The market price and the issue price will have to be same if we want that there should not be any loss to the new shareholders. The condition was there should not be any loss to the new shareholders. That means whatever price they are paying should be the price of company's share after all that contribution. So this was the third part. I hope you understood. It will take some time. Then calculate the total benefit from expansion to existing shareholders under each of the two financing option. Under each of the two financing option. Under right issue, what is the benefit to existing shareholder? Please mark it. They are not asking you to calculate the benefit to the new shareholder, but they are asking you to calculate the benefit to the existing shareholder, and it will be 20 in both the cases. I will just tell you how. See. Right issue. Earlier their wealth was 1030 crore before issue. Do you agree on this? Pre-issue. Then what happened? They contributed 150 crore from their own capital, or we can say that easily like this. Earlier they had 50 into 21.20, that is 1030 crore of the wealth. After that what happened? See, post issue they had how many shares? 60 crore shares. Do you agree on this? They had 60 crore shares. 10 crore shares were also subscribed, but the market price changed from 21.20 to 20.50. Do you agree? Because of the right issue, extra 10 crore shares, the market price changed to 20.50. 20.50. So now their wealth is 1230. Do you agree? But for that increase in the wealth, they paid something. Cash outflow. How much amount they paid to the company? 150 crore. It's the existing shareholder who purchased the right shares. So they paid 150. So 1230 minus 150, it goes to 1080. 21.20 into 50, 1060. It was 1060. So tell me, earlier their wealth was 1060. Now their total wealth is 1080. The benefit is 20. In the fifth part. In the second part, when you are going for public issue, tell me one thing. The new shareholders' wealth is 150 after the issue. We said that there should not be any loss to them. So we made sure that whatever they are contributing remains the same after also. So 150 crore remains 150 crore. So there is no gain to the new shareholder. The entire gain will be shared by the existing shareholders. I will tell you how. Pre-issue, it was 50 into 21.20, 1060. Post issue, the shares are same because rest of the shares have been 6.9444 have been subscribed or purchased by someone else. So existing shares are 50 only. After the issue, their market price increased to 21.60. Do you understand? 21.60. Calculate it. And they did not do anything. The new shares have been purchased by the new shareholders. So 50 into 21.60, it's 1080. Again the benefit of 20. In both the cases, the benefit to the existing shareholder is 20 only. Get it? This much is the only answer. In institute, they have given quite well. Like they have given two different alternatives, two different ways of calculating the answers for the right issue and for the fresh issue as well. You can do it your own way. I would prefer this one, the second option. It is very easy to understand. So with this we end the question number 54. It was quite interesting question and I enjoyed it a lot. After 54, question 55 comes up, which is quite easy. So let's solve it quickly. Progressive Corporation is planning to raise funds by making right issue of equity shares to finance its expansion. The existing ordinary share capital of the company is 1 crore. That is share capital. The par value of its share is 10 rupees. That means the face value. And the market price is 40. That means P0. The alternatives under consideration before the management for making right issue are given below. 4:5 at par means the subscription price will be 10 rupees. At par they are issuing the new shares. The discounted price is 10. At par means the 10. Par value is 10 rupees, right? And the subscription they are saying is at par. That means subscription will be at 10. Okay. This is 3:5 ratio. Subscription at 15. This is 2:5 ratio. Subscription at 20. This is 1:5 ratio. Subscription is at 25. So there are 4 different options through which we can raise money. Okay. How much we are raising? Can you get it? See, 1 crore of the total capital. 10 rupees is the par value. So can I clearly say that 10 lakh is the total number of share? And if 10 lakh is the total number of share, in the first case we are issuing 10 by 5 into 4. So somewhere around 8 lakh shares at 10. That means we are raising 80 lakhs in here. And in the second case it's 3:5. That means 10 by 5 into 3 into 15. That's 90. Somewhere 90 into 6. Okay, so different types of different amount is being raised in all the cases. So first of all, you are required to analyze for each alternative theoretical market price after right issue. What is the formula? Sir, basic formula, use it. N into P0 plus N1 into subscription divided by N plus N1. Very simple. N is this figure. Let me give you. I will just, this is going to be your homework. N is this figure. N1 is this figure. This is going to be subscription price. And 40 is the P0. See, all the 4 figures are there with you. You can calculate the first part. Second part is value of right. P0 minus P1. You have already calculated P1 in the first part. P0 is already there with you, 40. You can easily calculate value of the right. But yeah, we can calculate it easily. Value of the right, P0 minus P1. Okay. Then percentage increase in share capital. This is something new. How much percentage the share capital has increased? The share capital, existing share capital is 1 crore. Okay. See. Increase in the share capital is nothing but the number of new shares that you have issued. Earlier it was 10. And whatever you are issuing right now will become the increase in the share capital, and N1 is nothing but the ratio itself. So nothing else, it is just the ratio. You had 5 shares earlier, you are issuing 4 more, that means 80% increase is there. 5 plus 4, it is becoming 9 now. So 80% increase is there. In here 60% increase, 40% increase and 20% increase. Getting it? Just a second. Okay, so percentage increase in share capital was nothing but the ratio itself. Last one is good. Percentage increase in total funds. Earlier the value was 40. See, 40 into, you can clearly say 10 lakhs was the number of shares. So 400. Can I clearly say 400? Earlier it was like that. 400 was the total funds. How much you have added to it? It's very simple. The number of new shares that you have issued and the subscription price. That much you have added extra. the number of new shares 4 at the subscription price. Instead of 4 crore, you can clearly take this 5. So understand, earlier my wealth was n into p0, this much, and now you are adding this much. Getting it? Percentage increase in total funds. So you just have to take it like this, n1s divided by np0. You will get the percentage increase. Earlier the wealth was this much, np0, and now you are adding n1s. So you just take it into numerator, denominator, you will get the answer, na? See, n1s divided by np0. That's it, simple. Getting it? So this is going to be your answer. Cool. I will just leave it to you. From question number 56, preference shares valuation, and then thereafter bond valuation is starting. So we'll take it in the next lecture. For this, for now, this much is enough. I think we have learned a lot about the right shares, and it was very interesting. In the next lecture, we are going to continue with the preference share valuation. I hope you are doing it with the correct approach. Please follow the correct approach. Solve the question before I do it. You can watch the concept related videos, but before I start the question, just pause it or close the video and you do it yourself and then come back to the video. This is going to be the best approach and you are going to score a lot of marks if you are following this approach. Other than that, whatever approach you are following, you may not get that much of the result. So it's up to you what you do it. But before starting every lecture, please revise the formula book and the chart book till that point. Every time means every time, and I'm very much strong on that. Okay, that's it. Bye bye.